Hey everyone, welcome to another market review. This week was pretty confusing. We had data kind of all over the place. For example, we had weak PPI at 2.6 coming under. We had CPI at expectations at 2.9. This isn't yet updated for some reason, so this month's print at 2.9 isn't here, so it shows 2.7 from last month. Then we had a much bigger jobs revision than anticipated. It was 900K. And finally, even though CPI was hot and showing increases, due to initial claims coming in pretty hot, like 20K above or 25K, something like that, we had uh, kind of a scare, and the market decided to ignore CPI and basically pumped here. Actually, uh, I'll go back. Decided to pump on first day due to the initial claims. And initial claims were kind of strange as well. The only major increase was Texas. This is state by state. We have, for example, decrease in California. Illinois has a big decrease percentage-wise from the baseline, which was 11K. Large increase in Michigan, but overall, this was the only one that was an outlier. And because of this, it's likely fake data. And the answer came afterwards in this kind of uh, communique about this likely being fraud attempts to lift Texas jobless claims. We will see if this becomes something. I doubt it because we would have seen increases across the board if it was the case. And on top of this, continuous claims actually went down again. Not much, obviously, but just barely lower than previously thought. So this was continuous claims, and this was another minus 147%. Continuous claims is the red line here, and you can see it's pretty much flat and has been flat for a while. Now, how to interpret all of this data? I've been thinking about this quite a lot, and I don't think I am wrong. Like I was wrong about the market reaction, but we will get to that as well. Uh, but I think inflation is going to come in hotter and hotter. I think the jobs market is not going to break. There will likely be an upwards revision to the August jobs data because August, September are the least reliable uh, bearish months because it's vacation months and there's less answering to the survey data. So when people come back from August vacation and start answering the surveys again, they usually revise the numbers up. So this happened. The same thing happened last year. We had the August job scare. Then September came. We got the cut, but we also got the upwards revisions, and then we started moving higher again. So I think this year will basically be a almost identical repeat of last year. Jobs data like NFP and jobs creation for August will be revised up. Um, how I interpret the yearly revision, which was huge. So last year we got minus 800K, and this year we're getting minus 900K. How I read this is that the jobs market has been in this state for way, way, way longer than people thought. And even if we ignore last year's data, which I partially am, or giving it less weight than 100% weight, this year's data proves that we have been getting uh, increases in GDP and the economy is moving along not at a great pace, but still moving along okayishly in this jobs market. And basically, a reflection of this is the continuous claims number. essentially a flat line. Obviously goes up and down briefly, but it's a flat line. And this goes down to 2022. So since 2022, the market has been in this state in which we're just chugging along. And we basically it's a return to equilibrium for the jobs market. Since it's all data, like the revision of 900k jobs, it means that we are fine as is. It's not breaking down, it's not going higher, it's not booming, but it's not recession either. So this is kind of how I interpret the huge adjustment in number of jobs. It means we are at equilibrium, uh, and it's a pretty stable one. Like the continuous claims number show this that since 2022 we're basically been doing this, and when we zoom in even more, like slight increase, but again it's been going down a bit lately. Probably some seasonal adjustments there as well, but it's a flat line. Like you cannot assume that things are going badly because of this. Now GDP now it's at 3.1%. Market is assuming like three cuts by end of year. This is December 3rd, and basically this is three cuts, 74% chance. I think there's zero chance we get that unless the Fed cuts 50 basis points at this meeting, which again I don't think it's likely. We're getting 25 basis points most likely. And when we go back to inflation rate, there are two leading indicators for inflation with a 2 to 3 month lag, something like this. You can obviously argue for less or more, but the two indicators are. I'll just leave uh, one thing and then okay. So this is CPI, and this is I think this is ISM prices paid or Philly Fed. Oh, no, this is Philly Fed prices paid, and the offset is 2 months. We can potentially set it to three just for to be the same as for the other one. So 3 months lag delay, and you can see that in general, when we have spiked, we went significantly higher in CPI as well. Like even though this went much higher than CPI, this is still like six. You can see it on the second one. Uh, 6% on CPI. So Philly Fed prices paid jumped more. There was some falls as well here, but generally speaking, when Philly Fed prices paid goes up, so does CPI. And we are at the portion of the correlation when CPI is supposed to go up significantly. And the other one is ISM prices paid. We don't have that much data on this one as with uh, the other one, but this one looks much better correlated to CPI. And again, this has a 3 month lag. We're getting to the portion where we're supposed to be seeing the large bump in CPI. And I'm not saying that we'll go to match this, we will have to go at 5 CPI. I'm not saying we're going to 5, but even getting to 4 would be very scary for the market. So it won't go up as much as this one. Very likely for this to be the case as well here. But CPI going to 4% year over year is somewhat catastrophic from the market's perspective. So all leading indicators are, and this is not the only ones. There are a couple of others as well, like copper prices and so on. But everything is pointing to CPI and PPI going higher. And the fact that we've been in this jobs market for basically 2 years now at the minimum with little breakdown, and unemployment is still very low at 4.3. Um, we are very, very far from a recession, in my opinion. Now, another thing I looked at is um, let me go back. So with CPX, I looked at other recession periods in the past, and there's not that many. First one is the COVID crash, which I'm not counting because it's a flash crash basically. It happened way too quickly, and the context is very strange and different. So this one is kind of irrelevant. It's only like a month from February until March, end of March. So a 2 month recession, quote unquote, and pumped the hell out of it to get us out of it quickly. And like very strange circumstances. Then we have the 2007 2009 recession. Uh, One note here is that recessions are declared post factum and retroactively. So recession allegedly started in December 2007, but it was declared as a start in December 2008. So 1 year later is when we got the recession call. And one thing I would ask you is, can we actually get a recession without the market going down? And I think the answer is no. Because the US is so invested in the stock market, if stocks are not going down, then the impact on the real, I don't know, level of not level of income, on people's finances is not really felt. So a pre-requirement, in my opinion. So let me ask you differently: do we have a recession because stocks go down, or do stocks go down because we have a recession? And I think the simpler answer, or the one that makes more sense, is that we have a recession because stocks go down. So we have bad economic activity, so negative economic activity, but unless the market crashes or goes down significantly, like 20%, we will not get a recession. And I think in 2008, the only reason why we got a recession is, like, we've been going in this recession for a while, but at this point, instead of bouncing or finding some support, we crashed, and this actually amplified everything, because that and the reason is not economic. The reason is basically bullshit activity, illegal activity, giving credit when they weren't supposed to give credits. Like, financialized bullshit is the reason, not actual uh, actual reasons that matter for the economy. It was basically fraud, legalized fraud, but still fraud nonetheless. So, question is, had we not crashed in 2008 here, uh, would have we still gotten a recession? And I think the answer is no. So, first thing to note is that market was topping and was in a downtrend way before the crash happened. So we were in a recession allegedly from here, and then the crash happened and made it much worse. But we were in a recession in this area as well. Recessions don't start or don't happen while stocks are at all-time high. Where are we now? Well, stocks are at all-time high and trying to go higher and higher. It is very, very unlikely that we are in a recession. And not being in a recession, plus the jobs market showing that it's been living in this environment where job growth is much smaller than initially anticipated, but not getting worse and not getting better, meaning it's at equilibrium, means nothing is going to happen. There is no reason for the Fed to cut into spiking inflation. Now, going back further, this was 2001. Again, this was declared retroactively, but stocks were already going down. And the fact that stocks were going down was what amplified the recession dynamics, in my opinion, and continued to go down afterwards while the recession was happening as well. But again, there was already weakness. We did, stocks were not going higher while the recession happened. Then going back further, this one is a bit stranger because we had a large surge here. Then we had a drawdown. This was 20 something percent. 20, oh, almost 20%. But again, stocks before the recession level, aside from this spike here, stocks were basically going sideways. Like, if we actually look at it like this, we had a bit of an overshoot at the end before doing the bigger correction, but sideways. Basically, a year ahead of the recession call, we weren't going higher anymore. We were just going sideways, which is again not the case right now. Then 81, same kind of thing. Stocks were going down, had a bit of move up here, but basically bear market was happening. And then I'll disable this a second. Recession call here. Stocks were already going down for a while. had a bit of a bump, but going down. Same here, stocks were already going down when the recession was called, and so on. This is the only ones I marked. So nothing from our current setup is pointing to recession at all. Like there is no recession risk at all, in my opinion. Like if we were to go into a 6 month, not 6 month, that's too much. Like, but stocks should top out, start making lower highs, be in somewhat of a correction, and then when the recession call may come or something like this, let's say we do something like this, top out here, then go down, and we are down into September, and then jobs market actually breaks down. The stocks will not like this, so they will do another leg down, and then we do something like this, and recession is ended here, stocks bottom here, and start going higher and higher. This is kind of how a recession setup would look like, but this is not what we are seeing. We're going higher and higher. GDP now is at 3.1%. Unemployment is not spiking in any way. It's just a return to the historical means. There is no reason to cut. Um and the reason not to cut is because of this. Everything is pointing to inflation coming in higher over the next couple of months. If you remember from previous videos that I did over the past couple of months, I had examples for stuff like Nike expects price increases during the fall from the previous earnings. I think in the fall of 2025. And this is not the only company that said this. Like I don't remember exactly, but there were various names that's had this type of phrasing in their earnings calls. So we haven't actually seen the full impact from tariffs. The full impact is coming exactly during the fall. The Fed risks, we're basically seeing a copycat of last year. Last year we had a job scare, then the Fed cut, then we had a reacceleration, and the Fed looked like fools. Now it's going to be the same thing again. Exactly when the Fed cuts is, as you can see, like we are here, and we're supposed to get 2 months of very hot inflation prints. Again, I don't think this will go to like 5 or something, but even getting to 3.5 is something the Fed does not want, and it will cause panic in the market. Now, this being said, let's look at actual market stuff, and we have breadth first, just going through it a bit, and what significant divergence. While market was going higher, breadth was going lower. We have the McLaren oscillator, which has been going up and down around zero. And we've seen this type of behavior right before a drop, a more significant drop. This was right before the April drop. We saw it here in this area as well, leading into a larger correction. It wasn't huge or anything, but it, come on, I'm misclicking. 5.7%, and that's like uh, 620. And this is NIA, by the way, because McLaren oscillator is calculated on this one. We have this, which tracks various sector moves. Again, a significant bearish divergence on the latest top, and again, we get this type of move into tops. Uh, and UVol down devol, we had an 80, almost an 80 devol, no, an 80 devol on that move on Thursday, but doesn't mean anything. So from the bread data, uh, we are still closer to a top than to going higher, and it should be a larger correction. That's like the one from this area here. It should be 5%, 6% at a minimum, between 5 and 6% at a minimum, but it has the potential to be much higher. If we are actually heading towards a recession, this would be a correction that we do not get out of for a while. Like if like I drew in that area here, if let's say a recession is going to be declared, let's say in November or something, uh, something like this, then we should be seeing the market going into a downtrend. And when the recession is declared, or things become clear that we are actually heading towards a recession, meaning we have jobs data breaking down, and that's kind of it, we should be doing another leg down. The average drawdown in of a recession for the US market is like 23%, I think. So 23% is not quite like something like this. A retest of the April low, something like this would be the case. How big was this on NIA? It was very small actually, 15%. So this 25% is on SPX, or I'll look at it there. But if we are going to recession, the market should be going into a downtrend. And if the recession is confirmed or we get more negative numbers for jobs, then we do another leg down later on. I don't think this is the case. I think we are still in a bull market. I think we will do a correction, but instead of breaking down, when the jobs market recovers and actually maybe unemployment actually goes down in a short while, like over the fall, we will get a reacceleration down. But the Fed will still look like fools, and they will have enabled inflation to go much higher than it would have done so normally if they had not cut. Uh, okay, so now let's go to SPX, SPY. Looks like this. Got a rejection on Friday. This looks like a fake out. So what we want to see right now for the bearish case is this was a breakout from the rising wedge. These are generally bullish, and but if we go back into the rising wedge, it's a very bearish setup. So the entry for short here would not be this top here, is basically wait for it to go back inside the wedge, and if it turns the wedge into support, how it should play out is something like this, the bearish case. We go back in the wedge, we try to break out again, and then remain weak, and then we would search down and probably do the full breakdown, because this is a fake breakout. Target is still 620 area. This is how it would play out if the bearish scenario is the one that plays out, the fake breakout one. And I think there's still a good chance that this is what we are seeing right now, because once again VIX is not going lower. Yes, we are below 15, but higher low. We are still Bollinger Band still compressed, and it seems very unlikely that we are going to expand downwards. Like you see, we had an attempt to push higher here, but we couldn't do it. We couldn't go for the full expand, and now we are contracting again. So the chances of us going lower are for VIX is not that we cannot go lower. We can go lower, but it cannot be like a breakdown. We are capped at around 12, so we would do something like this for Bollinger Bands, and price would do something like this, bam, and then bam. This is the setup. So we either go to 12 and we are still in contraction. We won't be able to go into expansion for VIX because VIX is kind of capped at 12. Uh, uh, and that's kind of the limit. But because we're making higher lows, it's more likely that we will attempt to break out again, like we did here, like we did here. But first a failed, second failed, third one will probably not fail. And we go higher for VIX. I think this is kind of where we're going with this current setup. And VVIX kind of the same. Like VVIX has been going for lower highs for a while now. It hasn't broken down either. We kind of have a pennant going, from what I can see. Uh, And it's again very unlikely that this goes all the way to the apex to break out. I think it's much more likely that we have a move soon. We have this area of the free ghost prints. Maybe we go higher, maybe we don't. Most likely we don't. So basically that would this area here would be the top, then we go back down, blah blah blah. Doesn't matter afterwards. But my base case is that inflation will go higher. Uh, this could very likely be a fake breakout, and if we go back into the rising wedge, it will kind of validate that this is the setup. We haven't had the precondition of making lower highs. We're still making higher highs, but we need to see a lower high. Uh, and if we go down here and then try to go back up again and fail, that would be the lower high we are looking for. And when that is the lower high that we want to short, you can try to play this by catching a top, but it's very risky. Uh, I would suggest that you wait for this to go down, try to go up again, and this is where the short is. It may obviously not play out like this, we'll see, but my expectation is of this right now. And how much is it? This is 6%, 646 to get to the quarter open, and at 66, and 620 is 583. So somewhere in this range is my target. If the if it's proven that we are heading into a recession, then we will not hold here. If it is and we get reacceleration, we bounce here. So we shall see how the data plays out. Expectation is that we will get upwards revisions on jobs for August, and that might get a bit of a recovery in the jobs numbers afterwards as following. Inflation will continue to go higher, and that's kind of it. Next week we have OPEX as well. Flows go away, positive flows start going away on the 17th. We also have FOMC on the 17th, and starting on the 19th is going to be full blown weakness. So if it doesn't happen here either, I don't know what brings this market down. But the higher we go and the longer we stay without the correction, the higher the chance that the correction will actually come. So I will continue to remain in cash until I see the conditions for a correction. I'll probably go short, but not a huge size when that happens. Like most small plays from point to point. Like let's say I enter here, I'll play it until here, then take profit and see what happens. I took some IWM puts because, as I mentioned in the past, I think IWM is the short here. It has made large correction whenever it surged up. I thought it would look something like this. I still think this is likely to happen. This head and shoulders pattern is more like the oh, actually no, it is the correct one. So 10% correction IWM, probably Qs like 4 or 5, SPY 6, 7, something like this. And then this level here is the threshold for recession. If we're actually heading into a recession, we go lower. If we're not heading into a recession, we go higher. So hope this clarifies things a bit. Um, it's yeah, never mind. Okay, have a good one. Bye bye.